Now that we've recorded almost all the journal entries from our sofas, we should start preparing the balance of our T accounts, because we're going to need this not only to adjust our overhead account, but to prepare our cost of goods manufactured schedule and ultimately our income statement. The company would have a T account for every little thing that went on during the period. Like they would have hundreds of T accounts, and I don't want to give you guys hundreds of T accounts to do. So I'm only going to ask you in your first comprehensive assignment to find the balance of the T accounts that are necessary to complete the cost of goods manufactured schedule and ultimately the income statement. And they are these 9. Our 2 different raw material accounts, our 3 different WIP accounts, cost of goods sold, finished goods inventory, sales revenue, and manufacturing overhead. Let's start preparing our T accounts in the way that we always do. We'll start with raw materials inventory. I'm going to hit equals, and I'm going to go back to my journal entries, because whatever happens in the journal entry, you just transfer over to the T account. So in the very first entry that we did, way up at the top, we debited raw materials inventory direct for $2,400. Let's debit our T account for the same amount. So I'm going to click the cell that I want and hit enter, and it's going to bring that $2,400 over. What else happened to raw materials inventory? Well, we're going to have a credit to raw materials inventory when we use that materials, when we took it out of our raw materials and put it into production, into WIP. So I'm going to hit equals on the credit side. I'm going to go back to my journal entries, and I'm going to see that happen in the very next journal entry. We credited raw materials inventory direct for $8,500. If we credited it in the journal entry, we got a credit in the T account. So let's bring the $8,500 credit over to our T account by hitting enter, and there we go. You'll see down here that I have the balance going at all times for all of these T accounts. How did I do that? Well, it depends on what type of account it is. Inventory is always an asset account. Assets go up on the debit side, down on the credit side. So the balance of that would be equal to the sum of all of your debits minus the sum of all of your credits. Up here in the formula bar, if you can see that, I put equals sum, highlighted all 3 of the different debits that we had, minus the sum, and highlighted all of the different credits we had. And just to be thorough, I'll do it one more time. Deleting this out and starting from the get-go, this is going to equal the sum, open a parenthesis, of all of the debits that we have, close the first parenthesis, minus the sum, open a second parenthesis here, of all of the credits that we have, and close the parenthesis. And that is how I got to $15,500. All of your inventory accounts, be it raw materials, WIP, or finished goods, will all work that way. Debits minus credits. So will cost of goods sold, because cost of goods sold is an expense account. Debits minus credits, expenses, just like assets, go up on the debit side, down on the credit side. Revenues work the opposite way. They increase on the credit side and decrease on the debit side. So for this particular T account for sales revenue, the balance formula would be equal to the sum of your credits minus the sum of your debits. That's how the T's work. Let's continue to finish those T's. Let's move on to our next account, which is raw materials inventory, this time indirect. So I'm going to equals on the debit side, because I know we have a journal entry where we purchased raw materials. It's again the very first one. We purchased $5,000 worth of raw materials on January 1st. We debited that account for $5,000 in the entry. Let's put that debit in to our T accounts. And then I know we also used at least some of those raw materials inventory indirect during the period and put it into manufacturing overhead. So I'm going to hit equals on the credit side. I'm going to go back to my journal entry, and right there we credited raw materials inventory indirect for $5,000. So I'm going to hit enter, bring that on over, and the balance of our account now is 0. With the that's what the dash means in Excel speak, and it makes sense. We bought $5,000, we used $5,000, therefore at the end of the period we have none left. For our WIP accounts, we're going to have 3 debits for all of our different jobs, because we accounted for direct material costs, direct labor costs, and manufacturing overhead costs that went into those jobs. Let's bring those debits on over to our T's. So WIP inventory job 1 equals our first entry. We debited that account for $4,500 when we assigned $4,500 worth of material costs to that particular job. Nope, that was labor. Sorry, $3,500 worth of material costs that particular job. There we go. So let's bring that $3,500 debit over. Getting ahead of myself, but we'll bring that $4,500 debit for labor costs to job 1 over as well. And while we're at it, let's bring over that $7,000 debit we had to WIP inventory job 1 for the manufacturing overhead, which was allocated to that job. So we put all of those costs in. We had $15,000 of the total cost put in. Did we take costs out of WIP inventory job 1? We absolutely did. In this journal entry down here where we completed it, we took $15,000 worth of costs out of job 1 and put it into finished goods. So if we credited WIP inventory job 1 for $15,000 in the journal entry, we need to do the same thing in our T account. So let's bring that $15,000 credit over. And now the balance of WIP inventory job 1 is 0. Does that make sense? Absolutely. Job 1 is no longer a work in process. It should have 0 balance because we're not going to have a balance to an account for inventory that is a work in process when it is no longer WIP, when it's no longer a work in process. So for all completed jobs, the balance of your WIP inventory accounts related to that job should be 0 at the end of the period. WIP inventory job 2 is going to look real similar. We're going to do the same exact steps we did for job 1. I'm going to hit equals over here on the debit side because I know we have a material cost that was put into job number 2. And it's right here. It was $4,000. So I'm going to click on that and I'm going to hit enter. Over here on January 31st, we also assigned labor cost to job 2. That amount was $6,000. I'm going to click on that, hit enter. And then over here we have overhead, which was allocated to that job. How much overhead did we allocate to job 2? We allocated $8,000 worth of overhead to that particular job. And click that and hit enter to bring that number over. So we had $18,000 worth of WIP inventory in job 2. Did we take costs out of job 2 for WIP because it was no longer a work in process because we finished it? Back down to that same journal entry. Absolutely. We completed job number 2 during the month and we moved $18,000 of costs out of that account and into finished goods. So if we credited WIP inventory job 2 for $18,000 here in the journals, we should do the same thing in our T's. So I am going to hit equals. I'm going to go and grab that $18,000 credit to WIP inventory dash job 2 and bring it over to my T account. And the balance of that one, just like WIP inventory job 1, is 0, and it should be because job 2 is also completed. We shouldn't have a balance to its work in process inventory account. What about job 3? Well, let's go and bring our materials, labor, and overhead costs over to WIP inventory job 3. So in the materials entry, we debited WIP inventory job 3 for $1,000. Click on that, hit enter. Hit equals, go back to our journals, find our labor costs, which were assigned to job 3. Down here, we assigned $1,000 worth of labor costs. That sounds correct to me. I'll bring that on over. And then lastly, the overhead, which was allocated to job number 3. And we allocated down here $2,000 worth of overhead to job 3 during the period. We debited its subsidiary WIP account for job 3 for $2,000. Let's bring that debit over to our journal entries or to our T accounts. The balance of WIP inventory job 3 is $4,000. Should WIP inventory job 3 have a balance? And the answer to that is yes, because we did not complete job 3. Job number 3 is still in process. It's still a work in process. Its work in process account should still have a balance equal to the amount of cost that we committed to job 3. And our T accounts are saying that we have $4,000 worth of cost committed to job 3 right now, which is still a work in process at the end of the period. We have something else in our information that can tell us that that number is correct. It's our job cost record. What was the cost of job 3? It was $4,000. So that $4,000 that we had on the job cost record is represented in our T accounts. What about cost of goods sold? Well, we recorded one entry for cost of goods sold when we sold job number 2 earlier in the period. We obviously had a debit cost of goods sold for whatever the cost of job number 2 was at the time that we sold it. We can go to our journal entries and find that. When we sold job number 2, right down here, we debited cost of goods sold for $18,000. So let's bring that $18,000 debit on over to our journal entries. We don't have anything else for that right now, so let's move on to finished goods inventory. We moved the cost of completed jobs into finished goods inventory with a debit right here. When we completed job 1 and job 2, we put $33,000 worth of cost into finished goods. So let's bring that $33,000 debit over to our T's. And then when we made a sale, we credited finished goods inventory to take the cost out of finished goods. So let's go back to our journal entries and we'll find that right here. We credited finished goods inventory for $18,000. Means the balance of our finished goods inventory T account right now is 15 grand. Does that make sense? Well, what job right now is still in finished goods? We completed jobs 1 and 2. We sold job 2, which means job 1 is completed but not yet sold, which is the very definition of finished goods inventory. Well, job number 1 is chilling in finished goods inventory at whatever its cost was, but we can find out what its cost was by going to our job cost record. Job number 1 cost $15,000, and that makes sense. Therefore, since that's the only job that's in finished goods, that would be the balance of that account. So we have our $15,000 balance to finished goods. For sales revenue, we use that once. We credited it in the account. And that guy is right here. We credited that account for $46,000 when we sold job number 2. So the balance of sales revenue is simply $46,000. And then we have manufacturing overhead. For manufacturing overhead, actual costs incurred go on the debit side. Allocation, taking money out of the pool, happens on the credit side. Let's figure out what the current balance of our manufacturing overhead account is. I'm going to hit equals over here for our first debit because I know that we had a debit to manufacturing overhead when we accounted for the indirect materials that we used during production in the period. We debited that account for $5,000. We also had a debit to manufacturing overhead in our journals when we accounted for the amount of indirect labor that was used for production during the period. And right here, we debited manufacturing overhead for the $3,750 of indirect labor costs that we had. We debit it in the journal entry. We got to debit it in the T account. So let's bring that $3,750 debit over to our manufacturing overhead T. And then lastly, we had one more debit to manufacturing overhead, and that happened when we accounted for our actual overhead expenditures during the period. We had actual overhead expenditures of $8,150. So let's bring that on over. Did we credit manufacturing overhead at all during the period? We absolutely did. When we allocated costs to all of our jobs, we took the money out of the pool and we put it in to our job. So we're going to have one credit to manufacturing overhead, and it's going to be from the allocation entry. And that is going to happen right here. We got a credit to manufacturing overhead for $17,000 because we took $7,000 out of the pool, put it in job 1, $8,000 out of the pool, put it in job 2, $2,000 out of the pool, and put it in job 3. It totals up to 17 grand. So if I do that, we come up with a balance of negative $100 to manufacturing overhead. And that's a problem. And the reason that that's a problem is because manufacturing overhead is a temporary account. We need to get manufacturing overhead equal to 0 at the end of the period. What am I going to do here to do so? Well, let me just do some simple math underneath real fast. My debits add up to a total equal to the sum of $16,900. We only have one credit. It's for $17,000. I need to have, like all T accounts, them be balanced on both sides to have it equal out to 0. If I'm taking my debits and subtracting out my credits, so I have $17,000 on both sides, I'm going to have a balance of 0. So if I just debit manufacturing overhead for 100, change my formula up a little bit right here to get all of those cells, all the numbers in there. There we go. That's 17,000 on both sides, which will make our balance equal to 0. So at the end of every period, you need to figure out what you need to do to your manufacturing overhead T to get its balance to 0. And in our case, on January 31st, we needed to debit that account. We center it so it looks like the rest of them. There we go. Well, we can't have a debit in a T account with a debit in a journal entry, so we're going to have a debit to manufacturing overhead in our journal entry. So that's the blank guide that we got left on the bottom. On January 31st, we are going to have to debit our manufacturing overhead account for that $100 that we just had in the T account, which made it go down to zero. What am I going to do with the credits? Well, there's a lot of different methodologies you can use. The easiest one is just to write it off to cost of goods sold. In this case, we estimated, coming back over here, that we were going to have $17,000 worth of overhead costs. And that was a damn good guess. But you know what? It only added up to $16,900, which means we overstated our expense by just $100 during the period. If we overstated our expenses by $100 during the period, we should reduce our cost of goods sold by $100 so that it aligns with the actual expenses that we incurred. So to make this journal entry work, I am going to credit cost of goods sold for that same $100. What you do in journal entries, you need to do in your T account. So let me go over here, and cost of goods sold got credited for $100, bringing its balance down to $17,900 for the period. And lastly, we need a description for here. We adjusted for the over allocation because we had too much costs in there of overhead.